Right, hello and welcome everybody to today's webinar, Life Insurance Decoded, How to Tell One Product from Another. My name is Brian Leising. I'm one of the life insurance marketers here at Financial Brokerage in Omaha, Nebraska. If you're not familiar with Financial Brokerage already, we are a national marketing organization working with insurance agents and financial advisors all across the country in the areas of life insurance, annuities, long-term care, critical illness, Medicare supplements, and disability income insurance. As I mentioned, I work exclusively with life insurance over here and have counterparts that handle all of the other product lines. Today's session is the fifth in a series that I've called Basic Training for Life Insurance Sales. I get calls every day from folks asking some fairly simple questions on life insurance, and thought that maybe some training in the basics would be very relevant for everybody out there, and even for those who are experienced in the business. It's good to have a refresher from time to time because we don't always remember everything that we once knew. Now, how does this webinar tie into all of the others in the series? Well, in session 3, the Life Insurance Allocation Questionnaire webinar, we went through a series of questions you can ask your clients to help determine how much of their life insurance should be term, how much of their insurance should be permanent. And there was another section that asked what type of permanent insurance should they have. So that's great to go through that questionnaire with your clients, but that also means that you have to know a little bit about the different types of permanent insurance and how they're different from one another, because your client is probably going to ask questions, or they might have assumptions in their mind that are decades old and are no longer relevant for today's product offerings. So you have to know how to explain that. In the fourth session, just 2 weeks ago, we reviewed 4 reasons people will still need life insurance in their retirement years. And if you're purchasing a policy starting in your 50s or 60s, it's probably not going to be a term policy anymore. It's going to need to be something permanent. You may very easily outlive your term. And then what do? And you get to the point where maybe you're past the age at which you could convert that to something permanent, and then you're stuck. You might be uninsurable. So you are going to need some permanent life insurance component going into those retirement years. So once again, we have to know, well, what are we going to recommend to our clients, and how can we help explain that to them? So in today's webinar, what I'm going to do is give you a graphic representation of how all these products are related to one another. And this might look a little bit like a family tree, or the family tree of life insurance. We're going to kind of take you through the history of the products and give you some idea visually of how they're all related to one another. I think that really helps once we start getting into all of the fine-tuned details with all the products. So to start off, basically there are 2 types of life insurance. There's term and there's permanent. We're not going to talk about the term, but I'll just say this, that term life is meant for a period of time, or a term, a set period, 10, 20, even up to 40 years. And then the intent of term insurance is that it's going to go away. Your need is no longer a need, and you've either converted that to something permanent or you've let the policy drop away. That's the purpose of term. Permanent is meant to be there permanently until the client passes away. Now, you'll have some other options, but it's meant to be there for the client's entire life. Now, it doesn't necessarily mean that it's a whole life product, but that was one of the first iterations of permanent life. And really, if we want to further categorize permanent life into 2 main categories, all the policies out there fall into what we would call whole life or universal life. And we'll look into that in a little more detail here. So whole life insurance was the first form of permanent life. I couldn't tell you what year the first policy was issued or started, but with the whole life policy, you have a set premium or payment. The client is expected to pay that for their entire life, although there are short pay products out there as well. And the premiums do not change, and usually you don't have any options to vary your premiums. The premium, it is what it is. That's the price. Every year, every month, you can't pay less and then pay more later on. Now, whole life could be further divided into participating or non-participating products. Now, what does that mean? It just means, does the policy participate in dividends of the company that issued the policy? Some of these products will issue dividends, just like, say a stock might issue a dividend. You can receive that on your whole life policy. Some products are non-participating. They might just have guaranteed cash values, or they may have cash values that are based on a fixed interest rate. Now, another type of whole life that we see quite a bit is usually referred to as final expense. Now, final expense could be participating or non-participating. The ones I've seen are usually non-participating. They may have some guaranteed cash values, although that's not the primary purpose. The primary reason people purchase those. These are typically smaller face amount policies, $10, $25, maybe even up to $50,000. They're meant for burial expenses. They're usually sold to seniors who, for whatever reason, have not taken care of their basic life insurance needs previously. Maybe they had policies before and they dropped them. But it's a special subset of whole life insurance. Now, as we look at the universal life products, those could also be divided into a couple of main categories. We have variable life and fixed, and that has to do with how the interest is credited on those policies. And actually, I should back up a bit here. Universal life, when it was developed, was basically an unbundling of the components of a whole life policy. Instead of charging the client one cost of insurance charge every single year that was steady, now with universal life, they've unbundled all the components. Your insurance charges are lower in the early years of your policy to match your current insurance age, and then they increase as you get older, as your life expectancy decreases. It's meant so that a client could, if they want to, vary their premiums. There's a recommended premium that could be level and is meant to build up cash early on when those insurance charges are low, so that the cash is there to pay the insurance charges later on in a person's life when the charges increase tremendously. But that does give the client a little flexibility. They're not required to pay that particular premium. They could pay more, they could pay less. What most of these are dependent upon is cash value being inside the policy. And there are some exceptions to that, which we'll get into. So client pays the premium into the universal life. They take out the cost of insurance and other service charges, and then the client is credited interest on the remaining money. Now, if the interest is, if the money being credited is in the stock market itself, that's a securities product, and that's a variable universal life. If it's not in the stock market itself, then that is what we call a fixed universal life product. And we can further categorize those products here. And I'm going to start with the variable products over here that you see on the left. Variable products could have what we call a no-lapse guarantee, or they could be based on current assumptions. Current assumptions just means that as long as you have cash value inside your contract, it's in force. If it has an underlying no-lapse guarantee, then your policy may still be able to remain in force even if your cash value is zero. It's going to be dependent upon the client paying a specified premium every time, on time, taking no loans and no withdrawals. The exact wording will be inside the life insurance contract itself. So that's an option, even if the cash value goes to zero. Fixed products, where the interest or the money is not actually in the market, can be categorized into two main categories. You have the traditional fixed universal life, and that's where the client's money is getting credited with interest, and the interest rate is set ahead of time, is predetermined by the insurance company. Now, how do they determine that rate? Maybe their actuaries could tell you, and maybe you'd fall asleep in the process. We really don't know. They don't have to prove why or how they set that rate, but they're going to set that interest rate, and that's what your client receives. An index product, it's a little bit newer, goes back about 20 years, roughly the year 2000, when index policies were introduced. And that's actually a little more transparent, because with the fixed product, we don't know exactly how they arrived at that number. With an index product, you know exactly how your interest rate was calculated. It's calculated by a formula, and the formula tracks a published index. Usually, you're looking at the S&P 500. That's something you can find online. You can find it in any newspaper. And then the formula is in your policy. You could track that yourself if you wanted to and figure out what your interest rate was for that given time period. And that's done after that year or other time period has gone by. So fixed products could be either index or fixed. On top of that, with either an index or a fixed UL, you could have a current assumption product, which says, hey, to stay in force, you have to have cash value. Or it could have an underlying no-lapse guarantee, which means the product does not have to have cash values to stay in force. You just have to meet the criteria set out in the policy, which is basically, my shorthand for it is pay your premiums every time on time, take no loans, and take no withdrawals. And then you're going to have no problems at all. All right, and moving on, we can further distinguish current assumption products into those ULs that have an accumulation focus or a protection focus. So if we have a UL with an accumulation focus, this product was designed to build up a lot of cash value, and probably also designed so that the client could access that money at some point in time or various points in time through loans or maybe withdrawals, and then the policy is still going to remain in force. Now, as you take cash out of a policy, every dollar you take out reduces the death benefit, unless the loan has been paid off, or withdrawal would permanently reduce the death benefit by that exact dollar figure that you took out. But some products are meant for this purpose. It's a great way to get some tax-free money at any age out of a life insurance policy. Now, some of these products, and this is something a little bit newer that we've seen over the past 5 or 6 years, I'd say protection-focused UL. So with these, they will have some cash value growth more than, say, a traditional fixed UL, and they don't have a lifetime no-lapse guarantee, but they usually will include a life expectancy guarantee. So they might guarantee to roughly age 85 or 90. And while you could take cash value out of these products, that's not necessarily their primary purpose. Their primary purpose is to keep the policy in force for as long as the client lives. So these, if you illustrate them to last, past age 100 on a current basis, you'll see a premium that's usually about 15 or 20% below a no-lapse guarantee UL. You're giving up the guarantee, but in return for that, you're receiving a little bit lower premium. You'll have to monitor these, but we're seeing more and more business flow towards these protection-focused ULs. And that, I think, is really it. This is a short webinar. I'm going to give you a quick little recap of everything we covered on one page. If you have reading glasses, you might need them, because to fit everything on one page, we had to make it just a little bit smaller here. But to recap, there are two main types of life insurance. You've got term, which is temporary; permanent life, which is meant to always be around. You can further distinguish permanent into whole life or universal life. Of course, whole life could be participating with dividends or non-participating. And we don't want to forget about final expense, which are usually smaller whole life policies meant for seniors. On the universal life side, we have, in general, we have fixed products that are not in the market, and then we have variable products, which are securities, and of course subject to market losses. You can further categorize the fixed products into a traditional fixed interest rate that's set ahead of time, or an index product, which is very transparent and allows the client to usually participate in a good chunk of the upside of the market while never taking a loss. Again, it's not a securities product. It's still considered a fixed product. You do not need a securities license to sell an indexed UL. Any of these products could include a no-lapse guarantee. That's a set premium that will keep the policy in force for the life of the insured, or they could be a little bit more old-fashioned and go off of current assumptions, meaning you have to have cash value in your policy to keep it in force. And the current assumption products could come with an accumulation focus intended for clients to take money out at some point in time, or they could have a protection focus where cash value is secondary, but it's really meant to be a lower cost option for a client that wants coverage to last for their entire lifetime. So that is the end of today's webinar. I'll give everybody a few seconds to type in their questions in the control panel if you haven't done so already. But I do want to put in a little message about the next session in this life insurance basic training series. It's the 6th and final session, and that will take place on Wednesday, March 30th. I'll be reviewing a software program that you all have access to. There are no passwords at this time that are required. This comes from one of our partner companies, and it is a real-time client analysis software. You're going to love having this up on your computer when you're talking to a life insurance prospect. What it does is all you have to do is type in a little bit of information about your client, their age and their income, for example, and it's going to prompt you with some relevant questions and suggestions to be asking them during your conversation on the phone. It will even generate PDFs that you can email to your client while you're speaking. It's really like having an expert at your desktop while you're speaking to somebody. It's going to make you look 400% smarter than what you actually are. So you don't want to miss that session on March the 30th. But I want to thank everybody for joining us, and I'm going to hop into the questions right now.